All right. Good morning. Good morning. It's great to see everybody here today. First thing in the morning as we get ready for the opening bell here in the futures market. All right. So up in the upper left-hand corner, we have the S&P 500. In the upper right-hand corner, we have the Dow. Bottom left-hand corner, we have the Russell 2000. And in the bottom right-hand corner, we have the NASDAQ. And the morning bell is going to ring here in about 4 minutes, and we're going to watch these babies run, watch the ponies take off out of the gate, and we'll see which ones give us an opportunity to maybe put an order or two on here. See if we can't make a little bit of money. Scalp and trail on the morning bell. So that's what we're doing today, scalp and trail on the morning bell. So let's see if we can't make that happen. We're also going to, today on the agenda, we're going to review the trades that we did last week. I actually missed yesterday. We had a class scheduled for scalping the power hour yesterday. We were going to do that. That was on the schedule, but I never got the opportunity to come and put that presentation on because I had some business meetings I had to go to, and so I had to cancel that one and go conduct some real business, some real business. And so then I also have some ways that I handled my trading yesterday, and I took some screen captures, and so I'm going to share that with you. And so we'll look at that. I've got we've been trying to track our trades through the Excel spreadsheet, and so we need to update our Excel spreadsheet and show you what happened there. I've got some that we did in the demo account and then some that we did in the live account. So I want to show you how they turned out. I started them in the demo account, went over, put them in the live account, and then stopped paying any attention to the demo account version. So I don't know what happened to those. They just kind of closed out. And then I watched, obviously watched them, the real money accounts to see what happened. So I will tell you, show you what happened with the Wild Eye, Crazy Eye, Iron Butterfly on the real money accounts for the last three trades that happened over in real money. So, and then we're going to work today on the demo account to practice what we preach. All right. So we're going to practice a little bit of scalp and trail. I'm going to show you how that works. I'm going to show you the settings. I'm going to show you how I like to do it and show you the software I use, show you all the neat stuff. We got to go look at the news. Let's go look at the news while we wait. Let's come in here. Here's the news. All right. So there's the news. And that's not the news. Land, where's the news? Right there's the news. Okay, let's refresh this one. And we want to just see impact 2, not interested in impact 1s. And there's no reds today. So today's going to be a pretty quiet day. New home sales come out at 8 o'clock. So that actually moves the market a little bit on occasion. New home sales month over month. And then we have crude oil coming in at 8:30 and 2:30 bank stress test, whatever that means. What the heck does that mean? The Federal Reserve left the Fed fund target rate steady at 5.25 to 5.5 for a 7th consecutive meeting in June 2024, in line with forecasts. Policymakers do not expect it will be appropriate to reduce rates until they gained greater confidence that the inflation is moving substantially towards 2%. Meanwhile, the dot plot shows policymakers see only one rate cut this year and 4 reductions in 2025. Back in March, the Fed was seeing 3 cuts in 2024 and 3 in 2025. The Fed made no revisions to GDP growth projections and still sees the economy expanding 2.1% in 2024, 2.2% in 2025, and 2026. Meanwhile, PCE inflation was revised higher for 2024, 2.6 versus 2.4. They're leaving the interest rates where they are, which is good for those of us who have accounts that take advantage of high interest rates, right? So that's the name of the game. Isn't that the name of the game? The name of the game is when interest rates are low, you take advantage of opportunities to grow your portfolio based on low interest rates. And when interest rates are high, you switch your portfolio over and you take advantage of opportunities that make you money when interest rates are high. So that's how we do that, right? So if interest rates go up, great. We'll take advantage of high interest rates. Interest rates go down, great. Take advantage of low interest rates. So we just have to be smart enough to know how to move our money back and forth between the two and operate our operating capital that way. All right, what's going on here? Is the bell rung? Did we ring the bell? We did. The bell rang. That's the bell. So it looks like the Dow again is our big mover. Now in the past, it's been the Russell's been our nice mover, but recently it's been the Dow again. Dow kind of comes in and goes in and out of the nice move. Look at that beautiful drop right off of that was right as the bell rang. That thing flushed. Now this market here, this is the S&P, and this is a 5-minute chart. So it started to fall back here at 3:30 in the morning. And it hasn't looked back. Made one little look back right there and then continued. This is the opening range right here coming in, and we're dropping lower. That's not good for our long-term positions, but we've been talking about this, right? We've been looking for this market to make a pullback if we come into the daily chart on the, guess I don't need two of them. And we've been looking for this market to actually pull back down to this region here, right? So this is our kind of our target price for the S&P. We're looking for this market to come down here and test this red line. Why that red line? Well, because it's the high of this previous rally. And so that makes what we call a Fibonacci bow tie. All right. So you have a bow tie, comes down here, comes up here, and then it turns and comes back down and uses previous resistance as support. So that comes down here. And when you tie it off back to there, it looks like a bow tie. So we call it a Fibonacci bow tie because we have our drop, which is our Fibonacci calculation, which comes back into the Fibonacci sweet spot, right? So the market comes back down into this region here, which is between 38.2 and 61.8. That's called the Fibonacci sweet spot, all right, the neutral zone. So the market, when a market rallies, we anticipate it coming back down into the sweet spot or the neutral zone and then turning around and rallying back up. And once it does that, then we expect it to turn around, come back down into the Fibonacci sweet spot once again. So we just take our Fibonacci ruler and we move it like that. And then we expect it to come back down into the Fibonacci sweet spot once again, which in this case is right in here. And that just happens to correspond with that previous high right here, which puts us into the Fibonacci bow tie. All right. And that's how you read these markets. Markets have a tendency to just go through these 2 steps forward, 1 step back, 2 steps forward, 1 step back. And in the process of doing that, statistically speaking, now they don't happen every time because statistics just means that it happens often enough that it's something that we should pay attention to. If we come in here and we turn on the bulls and bears overlay preferences and we turn on the blue lights right there, watch that. Boom. We get these little blue lights in here. And then generally speaking, statistically speaking, we get 3 drives. So we'll get drive 1, we'll get drive 2, and then we'll get drive 3. So this will be a Fibonacci bow tie to the upside. Well, it should come down and this should start a new rally. And we'll get that 3rd drive going up into higher markets. We want to see it break above the previous high. So the idea on the 3rd drive, drive 1, drive 2, those are usually our biggest drives. Our 3rd drive oftentimes is the smallest drive, and it sometimes has a struggle to get back above this point here. But that's what we'll look for. We're going to look for this market to come down. And what we're really going to look for, let's get rid of some of these arrows. Delete all the arrows. We're going to look for this market to come down into this region here, break those blue lights, and then turn and start to rally again. So we're going to look for it to break. If we take a Fibonacci projection tool off of this previous volatility of the market, let's get rid of this one, and we'll get rid of this one, and we'll get rid of this one, and we'll get rid of this one. And we're going to put this one back. We're going to take that one and put it right back in there. All right, and we're going to take our Fibonacci projection tool, and we're going to go off of this low here to this high here. And we're just going to make a guesstimate of where we think this thing's going to come back to based on its projection. So we're going to say back to 50% or back to the red line right here, along where it looks like it's coming down, something like this, maybe out in here. And then if it gets out in here, this is where we'll look for it to turn around. So we can look at price and time on that. We're going to estimate around July 11th, July 10th time frame. We're going to hit this region, this zone down in here. All right. And then we're going to look for it to come back up and break this and try and break this high. All right, so we're going to try and get it to break this high. And if it can break that high, we're going to look for it to come up and maybe get up into this 100% region. I mean, it would be nice if it would go all the way to 130.9, but that's generally not what happens. All right, on this last third drive, it's just an effort to get it back up above here. And then this is where we start looking for a little bit more of a retracement. So that's what we're looking for here in the S&P. Now, in these indexes, you have to take into consideration that oftentimes they move and they don't make these perfect 3-drive Elliott wave retracement patterns. Oftentimes what we get is we'll get a third drive and then we'll get this little thing and it goes sideways for a little while. And then it starts to go back up. Like this here didn't really give us a full retracement. See, we had our multi-drive pattern high. If you come over here, in fact, there's 1, there's 2, there's 3 off of this little pullback here. But we actually had come back and you see that one. We actually had one giant move here. So we actually ended up with 4 drives. So 4 drives. Again, it's statistically speaking, we generally do 3. But you see this last drive, this last third, the 4th drive on here was really weak. Kind of really petered out on us. So in these indexes, you'll oftentimes see more than 3 drives. In individual stocks, it's more common to see the 3-drive pattern more prevalently. Okay, so then we get this big reset with all these red bars in here. And of course, this is all calculated based on Fibonacci. This is called the Bulls and Bears indicator. It's in Track and Trade. And that's why this market comes in and creates all these red bars like this, is because we got a full retracement. And based on Fibonacci and the calculations that we use to create the Bulls and Bears and use those blue lights, that's where you get your Fibonacci and your Elliott wave combination. All right, and that's how you read these markets. And then this thing comes around, turns around, starts a new system, a new series of drives. And so that's why we call this new drive 1, and this is new drive 2. It doesn't mean it can't stop and just come down here and cascade down. It certainly can. Markets can do anything they want. But as technical analysts, we look for reoccurring patterns. And the reoccurring pattern that we like to see when a market starts to trend like this is a 3-drive pattern. That third drive for the things comes down, again, usually isn't a huge one. Doesn't mean it can't be. Sometimes it can be, but sometimes it peters out, kind of like happened here. And so if we get this kind of a repeat of pattern up in here, we're just going to look for it to come up in here and then kind of maybe give us another reset of red bars. So that's what generally we anticipate. All right, as technical analysts. All right, so there's another way we can make that projection too. We can come in here. Let's get rid of this one. Let's come in here and get rid of all these. And we can take our Fibonacci projection tool. And we can go from this peak right here down to this peak, or this low, up to this peak. And then it kind of gives us a little bit better idea of the projection of where this thing go based on this previous volatility. So this is a volatility tool. It's just counting volatility. It depends on where you put your high, but the high was right here. So you generally want to go off the high. And then from that high to that low, moved in this rate of volatility. So we generally expect the market to continue doing the same volatility. And so we expect it to do the same thing. Now this one's slowing down a little bit. It's not quite as weak as this one was here. This one had a strong down volatility. This one's a little less, not quite so strong. So that's why I've projected out into the future a little bit further rather than taking this strong down volatility that we had in the first drop. All right. So that's how you do that. This is just a little volatility tool. I'm going to set you up the tools. I'm going to show you. So come over here to your preferences tab, and I'm going to get myself out of the way so you can see these. And those are your settings. All right. For your tool. Now, when you load Track and Trade for the first time, for those of you who don't even have Track and Trade, you got to get on the stick. Go get your software. Here it is. Go over and get your software. This is the software we're using. It's called Track and Trade Live Futures. All right. We also have the live stocks version when we go do the stocks version, and we've done some really good trades there. But we're focusing on the live futures right now because we like to do day trading with a small account, right? There's no pattern day trading rules. So we trade out of Chicago, not out of New York. And then this is where the software we need. We just need different software to trade out of Chicago. So that's the software you need. Go grab it. This little thing will take you over there with your cell phone if you scan that, but you can't install the software on your cell phone. So probably ought to take that stupid little thing off there. Just go to trackandtrade.com. That's just go over there, grab that tool, install it, and you'll be in good shape. And then you can come in here, take a picture. Now take your camera, take your little camera out of your left hand because it's hooked to us like it's a piece of our body, and take a picture of that left screen. All right, because when you get the software, it doesn't come out of the box the way I have all my settings. And if you guys go get the software, anybody who gets the software, you can sign up. Have I got my contact information in here? I do somewhere. You can sign up with me and I'll help you set up your software. I'd be happy to go through all the settings with you. Just go over to see if you need extra help. So here's a little there. You can scan that with your phone. How do you scan it? Some guys don't even know. You take your camera off of your phone. You go to your camera like you're going to take a picture, and you point it at those little squares, and it'll bring up a link in your camera window. And you just touch that link and it'll open it up in your browser. You don't take the picture, you just point it at it. Just use your camera, point it at these little square things. You see them everywhere. So a lot of guys are like, what are those things for? Just take your camera and point your camera phone at it, and it'll pop up a little thing in there, and you can touch it and it'll open up a website. All right. So you can do that and it'll take you over to my website. I'm not exactly sure where that one takes you. One of these three websites. But anyway, what you want to do is you want to go to landturner.setmore.com, and then that can set you up a private appointment. You can just come in and you can say, I think there's one in there for one free bowl session. So you sign up for your free bowl session, and then I will help you set up your TNT software. So I can help you do that because it doesn't come out of the box with all these settings that I like and that we use here in the software. So Kirk says, definitely like help with the TNT setup. If you would like help, then go do that. If you haven't had help yet, come on over. I'll help you set up your software. There's no charge for that. Why would I charge you for that? I'm just going to help you. Just trying to help you. And I try and help you in here a little bit, but I don't go through and actually do it for you. If you sign up, we do that GoToMeeting Zoom thing. I can see your screen, and then I can just go through real fast, go through each tool, and I go through and I set them up the way I like them. I go through the indicators that I use. I set them up the way I like them, and then I give you a little show you how to do it. So, okay, here's how that tool works real quick. And we just kind of do that together, just you and me. And if you want to do that one-on-one, you need my help, I'd be happy to help you. All right. So, take a picture of that picture, because that's how I like to set up the Fibonacci projection tools. And then if yours is set up like mine, then you can watch how I do it here in class, and then you can do it yourself. All right. So that's how it works. Okay, most everything comes out of the box kind of the way I like it, but there's a lot of things. There's a lot of tools in there that I change the colors on. Mostly it's colors. And then the bulls and bears, I set those up. I show you how I like the bulls and bears. The bulls and bears, I like it on a sensitivity of 72. And then the formula, I like to use the progressive formula. That's my favorite. And then I like to have the bulls and bears blue lights turned on because they give me the Elliott wave counts. And then I like to have arrows on all color changes turned on. Now that's kind of it's not a standard by default setting either. None of these are actually. If you hit TNT defaults, it'll turn all these things back to different settings. But I like to have arrows on all color change turned on, and because I like to show it every time it's coming out of the Fibonacci sweet spot to give me an arrow. All right, so that's how I set that up. And then I just hit save as my defaults. And then you can go to TNT defaults, and that's what the TNT defaults are. But if you hit my defaults, I'm a little bit more aggressive. This is a little bit not quite as aggressive. So then you say my defaults, because I saved them as my defaults. I hit my defaults, and it goes back to the way I like them. All right. So that's how that works. And now we're going to come over to back over to our charts, and let's go back in. Now, so that's what we're anticipating here on the S&P. So that's why we've been seeing some downtrends. And don't get worried about it right now. I mean, the probabilities of this thing collapsing and cascading down is pretty low because we're in a probability state. This is the top of the B drive. So all this stuff is the Elliott wave stuff. We're going to come in here. I'll show you how you count this. It's called the A1. This one here is called the B1 right here. And then the third drive will be called the C1. All right. And then the little fractal drives in between, we want to go ahead and we want to count all those as well. So we count those. And so that would be an A1. This would be in here. This would be our A2. We have an A3. We even have, I didn't quite do it, almost there. That's kind of a little, almost a little A4 in the A3, one little bar, but then the market failed right in there, which is what you anticipate it doing once it gets up into those higher A's, A2, and then we ended up with an A3. That wasn't really an A3 because it didn't ever fail hard enough to be an A3. And then you end up with your A3 failure up here. And that's really kind of what we're looking at up in here. And then this ends up, once it fails, you have, 3 little pullbacks in there, and then we drop back. This one came right back to the 50-period moving average. Then it started to rally once again. Again, that's back into that Fibonacci sweet spot, and that starts the new B drive. And the new B drive starts when it crosses those blue lights, and then we go into a B2. So B2 is counted right here when you get these little flag formations right here. See these little flag formations? This is what's happening. And we'll generally get 2 of those. So that would be B1, B2, B3. And then it goes up. And then at B3, this is where we start looking for it to fail and turn around and start to come back down. So this is just absolutely coming. This thing is driving like a train on rails. And since it's so perfect, I'm going to expect it to continue to be perfect. And perfect would be for it to come back to this spot right in here somewhere. All right. So we're going to expect to come down, break those blue lights. If it doesn't break the blue lights this time, it'll come up, and then it'll have to come down and break the blue lights next time and then go up. So we could get a little rally out of here and not break the blue lights. But right now, since we've got a B1, B2, B3, we're going to expect it to break those blue lights. Once it breaks the blue lights, we'll be starting into zone 3 or drive 3 into the C drive. All right. So that's how we read. And if you don't know how to count and do all this measuring, let's put you one more in here. This is called the X1 right in here. This is X1. And then this, of course, this is X2. And then we would anticipate up in here X3. Once we get to X3, we want to take short positions. That's where we want to start buying puts, right? So it's all in the probabilities, like going to the blackjack table and you have your probabilities table. That's how we trade too. You trade just like you're playing blackjack. You have to have a probabilities table. I've got a little thing here. Show you. So all this stuff is in my manual. So this is kind of the little outline. If you want to take a quick snapshot of that, but it's just like this is your A drive, this is your B drive, this is your C drive, and then on the way down you have an A drive coming down, B drive coming down, C drive coming down. It's like a blackjack table. You have your probabilities. This is the probabilities of the financial markets. And if you don't know this and you've never been taught this and you don't have any study on it, just go get my book. It's all in my book. There's a manual for this, and this is the class manual. And all of these probability tables and how all this stuff works is out on Amazon on this book. It's called the Stock Market Playbook of Strategies, the Fibonacci Effect. Just go out to Amazon, search Lan H. Turner. There's several old versions. Don't get the old versions. Make sure that you get the new latest version, which has just been updated. That's this version here. Make sure you get the one with the what do you call those things? Chess players on the front. All right. And then if you scan that little code right there, you can stick your phone up to your computer screen and scan that code. It'll take you right to the right one. So get that. It's 238 pages long. It's a workbook. It's an 8.5 by 11 book. So it's soft. And you lay it out on your desk, and it's a workbook. It's not a book that you read. You're not going to go lay in bed at night and read it. Well, you might, but it's designed to sit next to your computer, and then you perform the lessons that are in it on your computer. So you analyze markets with it, and it gives you all those probabilities. So it teaches you how to count and measure like this. So get that book, and that'll help you figure out how to do all of this stuff that I'm talking about. It talks about Fibonacci and Elliott wave and shows you how they work together and the retracements and the projections. Shows you all about the Fibonacci cone of probability and all that really neat stuff. All right. So that said, the reason we're sitting here and spending time on the daily chart is because this thing's been coming down. And this looks a little neutral today, but if we come to the 5-minute chart, look at what this thing did. This is the tank. This thing dropped like a rock. Come back to the daily chart, that's just that little move right down in there. I mean, it looks big on that other screen, but on this screen, it's just a tiny chart, right? So we can bring that up. So this is what we're looking at. This is just the last moves of the last few days right in here. And that last bar, open, high, low, close bar, this is what we're seeing right here, okay? So that's what we see. Now, that's what we're looking at. Now, interestingly enough, I drew these brackets around yesterday's high and low. Remember, we were talking with Kirk, and Kirk was mentioning that he likes to bracket those highs and lows, and we've done that on occasion, and we did it last week, and that's the highs and lows of the other day. So the market rallied up. Now it came right back into this dead center of that yesterday's opening range. Now, I want to show you what happened with our wild eye crazy eye. Let's go wait before we start doing option stuff. Let's go look quick. I'll close that chart. We'll see if there's not a day trading opportunity in here for us. That Russell is finally starting to take off and starting to run a little bit. Looks like the NASDAQ did a nice, look at the drives on NASDAQ. Here's drive 1, here's our counter trend, and here's drive 2. So we got a nice move on the NASDAQ. It'd be nice if we could see a third drive. We watch this thing pull back a little bit, give us a drive, pull back, break the lights, and then go up and make a third drive. That would be nice. Let's watch and see if that'll happen. This market's just coming down. We got a break, we got another down, and now we got another drive up and down. Remember, one up for every down. There's one up for every down. Sometimes it's a big up, and a counter trend would be a small down, and then another big up. That's an ABCD pattern, right? Again, if you don't know what the ABCD pattern is, I have a little picture of one here. But we talk extensively about these different patterns in the book. So if you want to learn all about what is an ABCD pattern, it's in the book. So here's an ABCD pattern. But this is, you have the rally, you have the pullback, and then it starts to rally once again. It's an ABCD pattern, right? This drive 1, counter trend, drive 2. The drives are actually longer, generally speaking, right, than the counter trends. The counter trends are short. We don't want to take the short positions on the counter trend down because they're generally too short. And then the market turns and starts to rally once again, and then that one's generally longer. And so you can usually make a little bit of money on that one. So that's how you read those ABC patterns, all right? So as a market rallies up like that, that's what we want to see. And then we want to see a little counter trend come down. Then we want to see it turn and start to rally once again. Oh, look, while we were off looking at the other thing, there's what happened. So we got a little counter trend right here. Didn't quite break those lights, did it? Very small one, little pullback. You see lower highs in there, and then it turned and started to go back up again. We're getting the same thing over here on the Russell. We got a rally. We got the little pullback in here. Now we're looking and anticipating another rally. That S&P is really starting to rally, come back up, isn't it? So that's nice to see. How far is that Russell going to go? It's coming up there and hitting that VWAP. Problem with what we're seeing here on the Russell, and I'm like, Land, take a long position, go long right there on the Russell. Well, the reason I'm hesitating is because we got the VWAP right there, and the VWAP is called the volume weighted average price. And volume weighted average price is kind of like Ross likes to call them stoplights. And that's a really strong stoplight. That's not just a stop sign, that's a stop light. So markets like to come up, touch those, and then turn around and rebound off of them. So you got to be real careful with that. It's called I like to call them the rubber band. The rubber band is where the market kind of pulls the market to the rubber band. If it's above it, it'll generally pull it back down to it. If it's below it, it generally pulls it back up to it. So the market likes to swing back and forth across that VWAP. So just be mindful of that. And right now it's coming up, and I'm seeing that as an area of resistance. That's why I didn't want to take a long position right there. If it breaks through it, then we can anticipate a continuation of a higher trend, but it's got to break through it first. Okay, we're getting a rejection here on the NASDAQ. NASDAQ starting to pull back. Now the Dow is starting to rally. This looks like a spot I might want to take a position on the Dow. All right, so we're going to come in here. I missed it with my trailing entry, so I'm just going to knock one in there real quick, see if it wants to go. If it does, we could drop a second one in there, see if we can't get 2 contracts off. But if it doesn't go, we just have to get out. It's not going. Oh, come on, you rotten little dog. That wasn't good. Gave us a false break to the long side. Sometimes that's a good signal to go short. Now, look at what it's doing. It's rattling around like a rattle in a baby's hand. I thought we were going to get something there. I thought we were going to get a continuation of that up push. We still might, but it's showing weakness right now. If it'll give us a little bit of a push, we'll try and take another long here. I don't really want to go short, although look at the NASDAQ, it's flushing. This could be a down flush here too. We could get an ABC to the downside, right? A, B, C. There, I'm probably missing my long position entry. Doggone it. I was talking and drawing pictures. Shouldn't have got out so soon, Lan. Well, that's what happens. Let's see if it wants to give us another opportunity to get in. Starting to show some weakness here. I'm not really fond of it. Sitting right there in the neutral zone. Fibonacci neutral zone. We just got a down arrow. Broke out the neutral zone to the downside. That's negative. Should we take one short, see if it wants to fall some more? Put our stop in here. We don't want to take a big risk. If it just doesn't go immediately in our favor, we just get back out. If the market rattles around and bounces back and forth, it's not a trade you want to be in anyway. So we'll just get back out. This one here is starting to try and go long. I'm going to try and take that long position right there. I got it. That Dow knocked us out again. So we'll see if we can't get something going here on the NASDAQ. This is the range 20. It's not a 1 minute chart. It's not a 2 minute chart. It's not a 5 minute chart. It's a range bar chart. I usually have the micro mini on the NASDAQ, but we've got the full size mini in here this time. So I better break and go. I got my stop one price bar back, and it's showing weakness too. Come on, don't give me those lower lows. I want higher lows. If I stop getting higher lows, I just get out. There it is. It broke. It's not a higher low. Come on, you stinking little dog. It's losing its strength. Come on. Push it up there. Push it up there. I'm going to stick this on the ATR. We're just going to trail that on the ATR. All right. Now we need that to go. We need it to rally. Look, the Dow died. It's just rattling back and forth. Worthless market. Come on, you stinker. NASDAQ just died too. Yeah, that's it. Didn't catch one there, did we? It might be a little ABC to the downside. So it might be coming in here, A, B, C, and now it's just going to flush again. I thought we might get a little ABC to the upside. Remember, we always only have 33% chance of being right. That market can either go up, it can go down, or it can go sideways. In both instances, we were wrong. The top one, it just started going sideways. That's why it got knocked out twice in the Dow. In the NASDAQ, we just picked wrong. We picked long, and it went down. So we picked that. We thought it was going to continue up, and nope, it says I'm going to continue down. So we just picked the wrong direction on that one, because if we'd have picked down, we'd be in it right now, short, making some money. But we're only right 33% of the time. 66% of the time, market can go sideways, or it can go in the opposite direction that we picked. You just have to pick the right direction. And if you're wrong, just get out. Don't take a big loss and wait for it to go and turn around and come back and go in your direction, because it might take a very long time for it to do that. And by the time it turns around and goes in your direction, well, then you're SOL. Well, here it's trying to break out. The Dow's trying to break out again. The NASDAQ's coming down and bouncing off of that 200 period moving average. Let's see if it breaks through it, turns around, and starts to go. We'll try and get in right here. That's a bounce off the 200, and it's breaking the blue lights or the yellow. That could just be another counter trend. Don't want to trade the counter trends. And put my stop in here real close. If it's wrong, it's wrong. Let's see if it wants to go. Market's not being very fun right now. It's just going not very strong. Come on, let's get a push out of the NASDAQ. If it doesn't go, then we'll go over and look at options. It's killed us again. Market's not being friendly for day trading. I guess we'll sit on our hands a little bit here. Down $185. I got to take some tea. Hold on a second. I'm losing my voice. Yeah, Kirk's got it. It's chop, 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 chop. It's just chopping us up. It's not doing us any good today. There goes a little move in the Dow. I wonder if it's going to continue. What we want to see is we want to see it rally. Let's see it rally up and make a nice move, and then it'll get a little pullback, and we'll anticipate the next run. But I'm not going to take the first breakout. So we tried that 2 or 3 times, and that didn't work for us. The Russell's trying to run. Got a nice little break right there off that trend line. Nice little break off that trend line. It's hitting that. It's hitting that VWAP again. See if we can break through the VWAP. The Dow's having a hard time getting past the volume weighted average price. We're getting a little rally right here on the NASDAQ off that arrow, off that Fibonacci break. It broke out of the Fibonacci sweet zone. It's trying to go. We're getting a little push. You might want to try the Dow one more time. See if the Dow wants to break higher. I think we'll try the Dow one more time. If this trade doesn't go through, we're going to go look at options. Okay, break through that 200 period and rock and roll. Take off and go to the moon. The Russell's pushing. Anybody catch that Russell move? Oh, Mark, I'm sorry you got stuck in that. You'd have to call the guys over at the office and ask them. I know there's a few guys that are doing it, and I can't remember their names off the top of my head. Probably ought to ask them before we start putting their names out. Advertise them on YouTube. Hey, this guy's doing Nevada out of Canada. But it's the only way you can trade out of Canada anymore. Canada, now look, Dow just died again. There's nothing going on for us here. Nothing parabolic. We need it to be parabolic. We need it to go. Need an excitement thing. But that's good for our option strategies. It's kind of what you want is a dead market if you're going to trade the neutral option strategies, right? Canada changed their laws. They want to be very protective. They don't want to let Canadians aren't allowed to trade in the United States anymore. They took that away from you. They want to protect you. Government, big government coming in telling you what you can do. So that's your good old prime minister up there being big daddy, overseeing you, watching you, making sure you don't do something he doesn't want you to do. So you have to open up an LLC in the United States, and then you can trade your LLC. Most people open up Nevada LLCs because there's no state tax down there, and then they have very favorable corporate taxes or corporate laws to let you open up your corporation and not have to live in Nevada to do it. Market's trying to move. I mean, it's trying to do some stuff here. It's making some little snaky patterns. It's just not really moving far enough to get your profit box. All right, let's go look at let's bring up Let's start a couple of days ago because I missed yesterday. I didn't have I had to actually be at a meeting. But I put on an order yesterday. I'll tell you what I did yesterday. This is 2 days ago. This is Friday, I think. This was Friday, I think. I think this is Friday. What's the date? 6/24. When was 6/24? Oh, it was Monday. Monday? What happened to our Friday trade? Let's pull up our spreadsheet. Friday's trade, I think, was that a real money trade? No, the Friday one was, but Thursday was not. We went over and that's where we traded stock options. Oh, I put these in the wrong column. These are futures options over here. All right, so let's grab that and fix that. Okay, so those were stock options. That's when we went over and traded stock options. This is where we've been doing the neutral option strategy. So on Friday, we put on a neutral option strategy and it made $700. Now I put that on in the demo account, and that's the one you guys saw. And after the class, I went and just put the same thing on. Is that the one we did on this? This was Mondays. So I'd have to go look for the screenshots. It's got to be in here. What's the Friday was the 21st. So that's this one. All right. So this is what we did on Friday. So that was Fridays. And this is where we did the put skew. And this is where the market took off and went crazy on us, wasn't it? Didn't Friday go absolutely nuts, so bonkers? And we ended up with, where's our spreadsheet? On Friday. Oh, well, no, that one worked. We made $700 on that one. And then the next day we had some leftovers and I ended up putting it on again in the market. That's where the market took off and went to the moon. So I got some pictures of that for you. And we lost $650. That was real money. This was real money. See that $700 right there? I put it in there. That's where I apologize because I wasn't tracking the demo account one that we did here in class very well because I went and put one on in real money after the class was over. And we ended up with a nice profit of $700. And then the next day was this one here, the 650 loss. That was Monday. And I think that's this one, the 24th. Is it 24? Yeah. So this one here is what happened on Monday. And so notice when I put this on, I put it on right here. And the market kind of stayed neutral for quite a while, and it actually rallied outside of our cone of profit. But our cone of profit grows. So, I mean, the further into the day you go, the bigger the cone is that you can profitability. The cone's really small in the beginning. If it's got to be inside that cone, inside that green cone to make money. So in the morning, and when you first put it on, you're like, well, I don't care if it leaves the cone. That's it's going to probably leave the cone. It's so tiny. But in the end of the day, you want it to be inside this green cone. That's your break even. All right, out there. That's where you start losing money outside the wings. Now I had wings on out here. I put these on outside. Notice because I thought the market was just going to die and go sideways. And so I thought we were going to have a nice, good dead market that day. And so I put on less aggressive wings, which cost less money, right? But they give you less insurance. So what happened is this market came through and it ended up way down here. And I let it go all the way. I didn't take it off. I probably should have put in there. I mean, hindsight's 20/20, right? I should have probably put in there and take it off at 25%. And I probably would have come off right in here somewhere and I'd have probably been okay. But I didn't do that because I wanted to collect full premium. You notice I put them both on the same ticket. They're both on the same ticket in here. Can you see the numbers? Let me pull this up so you can see the dollar amounts in there. There you go. But you can see that I had them all on the same ticket. And usually I'll put them on two different tickets, right? And take them off. Just take off the center ones and leave the outside ones running. And then see if I want to put on another set of the center ones if the market comes back to and this one never did. I tried to come back right here. But I was gone, and I was running some meetings. I had some meetings to go to, and I just let this thing go all the way till expiration. So it got all the way to the expiration. I got full profit. You can see I got full profit on the ones I sold. So here's sell call. I got the full $452. And then here's the sold put right here. And that one I lost the $670. My insurance premium, the buy the put, didn't cover the full amount. See, I lost 670, and the insurance policy, I had a bigger deductible, and it ended up with a $587 profit, which didn't cover my loss here. And then this ended up coming in here, and it did the same thing. But this is the demo account version. This is the one I took the picture of on the demo account. But the real account one, I lost $700 because I started it right here. I started it out here, and the minute I put it on, this thing flushed. I don't think I have a picture of the real money one. I think this is just yesterday's. So anyway, let me look one more time, see if I got, what's this one? No, that's not anything either. Oh, I think that's the right date right there. 21. Oh no, that was Friday's again. Okay. So anyway, that's how that turned out. This one, the classroom, this only lost $80. You can see down here, lost $80. But that's not what I did with my real money, because after class was over, I waited out till here, and when it hit the dead center of the market, that's where I put it on. So I put mine on right on that arrow. I couldn't have timed it any worse, and it just flushed right out. And I had the same insurance policy, and so my real money account, this one, the demo account, had we done this one, it shows $80 loss, but in reality, I did the real money one that day, lost $650. So I repeated what I did on Friday, but this time the market ran like a wild dog outside the cone, lost everything. Lesson I'm learning. I'm leaning towards putting at the money buy call and buy put options as a better hedge, where we've decided that, hey, we've done the historical back testing and this thing leaves the cone of probability 66% of the time. We got to have a better hedge. And so I lost $650 of my $700 that I won the previous day. So that's what happened. And so then this one here, this is where I put on a stronger hedge, and I put them at the money. So here is an at the money, and that's what happened there. So that one, we ended up with $349.20. I think that's what I put in there, $349. Oh, I missed my 20 cents. Don't miss your 20 cents, Lan. 349.20. So that was, again, this was another real money trade. So I put this one on with real money. And then what I did this time is I put on what you can see is I bought the insurance policies at the money this time. So I sold them at the money, and then I bought them with 1 day to expiration at the money. So I sold the 0 days till expiration at the money, bought 1 day to expiration, the exact same options, only with 1 day to expiration at the money. So they were right on top of each other. And then what I did is, because I knew I had another meeting and I didn't want to get caught in that situation where I was not there to tend my trade, I knew I wasn't going to be around, I just put an order in there, a limit order, to take it off, to take the profits off at 25%. And so what happened is 25% was $250, and you can see I made $350. What happens, I had a limit order on there, and I think the reason they gave me more money than I asked for, because I said, hey, take me off at 250, which was 25%, but they took me off and gave me 349. The reason I think they did that is because they couldn't get the order filled, because I had all 4 orders on the same ticket. And so when you do that, you put all 4 orders on the same ticket, they have to liquidate all 4 orders at the same time, all 4 options. They can't go and leg you in and leg you out when you liquidate. If they can't get somebody to take the whole set off at once, they can't take it off. So what they're doing, and it's the exchanges, it's the clearing firms, but it's a computer. So the computer is trying to match up all 4 options, and they've got to wait. Now, the rule of a limit order, remember, for those of you who have taken my class, The rules of a limit order are that the market has to give you the price you specify or better. It can't give you anything worse. So it has to give you what you specify or better, or it won't fill it. And so I think what happened is the market came back, and as it was going through that profit zone, it hit 250, and then the computer starts trying to close those positions out, but it can't find anybody to take all 4 of them at once. It can't match them up. It's sitting there trying to match them up. And then it doesn't have to go to the same guy, and it doesn't have to go to the same clearing firm. It doesn't have to go to the same. It just has to find all at the same time where it can clear all those off at once. And so if nobody's buying one day till expiration straddles or strangles, they can't liquidate it. Nobody's buying it. They might be able to get a market maker to take it, but the market maker is going to require a larger spread because they want bigger money, right? So they're having a hard time. The computer is sitting there constantly banging against it, trying to find a setup where it can liquidate all 4 of those options at the same time. That's why sometimes you'll get into an option strategy and you can't get out, all right, because they can't find somebody to take your other position. So the more options you put onto your ticket, Track and Trade only does 4. Sometimes you can do 6 on a ticket but if you get 6 on one ticket, it's really hard for the market to clear all those out at once because it's got to fill all of them at the same time. Now, again, they don't have to go off to the same guy. The same guy doesn't have to buy the exact opposite of what you're trying to sell, but they have to be able to match up all those orders. That's why when we look at options, we want to always make sure that we got plenty of volume and open interest. All right. And that's the reason why, because the more we stack onto this thing, the more difficult it is to fill your orders. So in this case, the S&P has pretty good volume. Look at that, thousands up in here in the open interest. We generally want it over 100 on our volume, and we want over 1,000 on our open interest. And that's the reason why, because if you're going to put 4 orders on one ticket, they got to really work hard to get all 4 of those filled for you to get in as well as to get out. So that's why you can end up with slippage. But if you use a limit order to get in, they're not going to slip you against you. You just might not get your order filled. And they're not going to get out if you use a limit order. They're not going to slip it against you. You just might not get your order filled. You might not get out, but that's because they can't lock up all 4 of them. So the point I'm trying to make is that if we break our orders up and just put 2 on one ticket and 2 on the other ticket, it's a lot easier for us to get our orders filled. We might put an order in for 2 and take those 2 off, and they'll come off just like that because it's easy to get 2 off, but it can't get all 4 off. And so that's why it's better oftentimes to break your orders up, have these strategies that have four legs in them, to break them onto 2 tickets, and then liquidate one side and liquidate the other side independently so that you can get them out a lot faster and a lot easier. Now, this time it worked in my favor, because I told them to take it off at $250 profit, just at 25%, and they couldn't get them all filled until the market had moved far enough where I made $350. So they had to give me the $350 because that's when they could get all 4 of my options filled. All right. So that was a real money trade, and that came off at 350, 349.20. Okay. And I took all 4 off, rather than just taking 2 off because I didn't want to have to deal with it. I was out of the office most of the day yesterday. All right, let's go see what's no free will. Sometimes you get some free will there, Michael Bruce. Little free willy going on there. I got a little free freedom, a little free bump yesterday. I asked for 250, they gave me 350. So you got yours. Yours did a nice one yesterday. What did you do? You want to give us a little details? Tell us what you did. Oh, there's where you're telling us. I put credit spread wiped out my profits on Monday. My first loss in a long while. My credit put spread wiped out my profits on Monday. Uh-oh. Hope it wasn't all your profits. Sometimes you put on some of these option strategies and they win in such a high percentage of the time. Like you put on these put credit spreads at delta 20 and delta 30. You have a really high percentage of success. You win. And then the one that loses wipes out all the profit from the 10 winners. So you got to be careful with that. So that's some of those other types of strategy. That's why I'm working so hard on this iron butterfly, because it's got a reverse profit loss ratio. So it doesn't, when you lose, you don't lose everything that you made. It's a little bit, but you don't make as much. Well, it's a good money maker. You don't make as much as often. I mean, you don't have as many winners, but your losers, you have more of them, but they don't wipe you out. Especially if we do what we did yesterday, which is put it on. Are we ready to put another one on? We're right at the VWAP. That's where I like to put them on, Kirk. You like to put them on in the center, when it's in the center of the high and the low of the day. So like if that was our bracket, our 5-minute bracket, I like to put them on when it comes to the VWAP, because the volume weighted average price is like a rubber band. If you watch that market, it likes to come back to the VWAP. So anytime it's back at the VWAP, that's dead center, and that's where I like to put my sold options on. And I think it's better to put them on in 2 tickets. I put them on a single ticket yesterday, and I told it to take the whole ticket off. That's why I got the slippage. It slipped in my favor, fortunately, but it could have made it so it didn't fill the order, and then I wouldn't have had it, and I had to carry that thing all the way to the end. Not that that's a bad thing. If it carries it all the way to the end, you get 100% profit. You get your full. See, when you sell an option and you let it go all the way to expiration, you get the full premium. But they're going to put it. They're going to give you they're going to assign you a position in the worst position, in the worst direction. So whatever makes you lose money is the direction they're going to assign you. 1 contract, all right, for every contract you put on. So if you put on 3, you're going to get 3 contracts. You put on 1, you're going to get 1 contract in the direction that would lose you the most money. That's why you need a hedge. But you're going to collect your full premium, all the premium. So if you sell it, in this case, let's come in and do a 0 days right here. We'll do one right now. We're going to come in here at 460 and 367. We're going to go ahead and we're going to sell that one. And we're going to sell that one. So right at the money, if we let that thing go to expiration, we get all that money, 453 and 367. We get it all. Irregardless of anything else. We're going to get that money no matter what. That's ours. Now, how far the market moves one direction or another is going to determine. Let's go ahead and you don't generally want to sell your options first, but I'm going to do it right now because the market's leaving my zone. So I'm going to go ahead and mark it into these 1625 at the bid, place my order. We should get in. All right. So we got that filled. This is a demo account. I would never do that in a real money account, because that now required me to have like a $12,000 margin. Not that that's a problem with our account. We have $45,000, but that's not really, you want to have your insurance policy on there too. So we're going to come in here and we're going to buy 1 day, and we're just going to buy the same ones at the money. Now I'm paying more money for them, but not that much more, a couple $100. So see, I'm putting on there 1,400, but I'm receiving 1,000. So, but that 1,400 has to last for 2 days. So the decay is going to be less, but I got this really good insurance policy in case the market moves. They're going to give me a position from right where I sold them, but I'm also going to have a long position from right where I sold them. That's why you're buying a lot of insurance. Okay. In this case, you're buying 100% insurance. And so the situation is going to be that they're going to put you in a position. Now the market ran a little bit away from so I do have just a little bit from here to here less. So about $175. So I'm not exactly on top of each other there. I'm exactly on top of each other, but the price had moved away from my sold options. So there's a little bit of a skew in there. But now I have my position. If I come over here, I got it on 2 tickets, right? And I've got a perfect hedge. So if both of them close out, whatever I'm losing on this one will be covered from the other one, right from where I got in. Now, you're still going to have a delta a little bit less. So unless it goes all the way to the very end of the second day, you're not going to be completely covered. Michael Bruce is giving us little details on what he did. Let's see what he did. I sold 0 days till expiration, 552 call, a 0 day till expiration, 553 put. So you had a gap between them with a 3 days till expiration, 5535 call and a 5520. Oh, okay. So you had almost like a miniature iron condor. Miniature iron calendar condor. Because you had them all really close. You put them one strike away. See, that's what I did, Michael Bruce, too. On the one that I lost on, I put it one strike away, which was this one here. No, it was this one here. See, I put mine one strike away as well. And that's the one I lost on. Because the market, as you can see, fell way outside of my cone of probability. And the insurance just wasn't good enough because I won. That's just one strike. This is a 5-minute chart. So that's just one strike out, and it wasn't good enough to cover my loss. So I needed better insurance. Now, it's one of those situations where we've talked before. Do you want to buy good insurance all the time? Do you need 100% insurance if the market's if all you're going to do is drive to the grocery store every day? Well, I have really lousy insurance because I don't think I'm going to get beat up too badly just driving to the grocery store every day. But maybe one day there's a big event going on like the 4th of July and you need to go to the grocery store. Well, if you got a million people driving on the road, you got a bigger chance of needing some better insurance. So that's the game that we play as traders. We're trying to decide how much insurance we need. So the better you are at gauging whether the market's going to be neutral and just stay inside that cone of probability, the better you're going to be at determining how much insurance you need. But if you're not very good at determining if the market's going to stay neutral all day, you better buy better insurance. And, we do our very best wild ass guess. We do our scientific wild ass guess the very best we can. We do our swag, right? We do our scientific wild ass guess. We don't want to just wild ass guess. We want to be as scientific about it as we possibly can, but everything's just a wild ass guess because nobody knows what the market's going to do. You can do your very best technical analysis and then the market can go completely bonkers and go absolutely opposite of what you completely projected. So we're going to do our very best we can and then place our orders based on that information, that knowledge. But, I'm leaning towards just putting on some really killer insurance policy every time because there's been just 2 or 3 times where it's just kicked my hiney, right? And I wish I had better insurance. This is one of them. I lost $600 in my real money account. Now, had I done it when this one only lost $80. Didn't make any money, but it only lost $80. Mine lost $600 because I did it way out here, and the minute I put it on, the market flushed all the way down. It just went straight out. So that was not good. Oh, look at this. This market rallied up and then flushed right back down. So we're down $35. You can't look at the very beginning of this thing and get any kind of reading on it. What we want to do is we want to look now is how much is our premium? Our premium that we're collecting is, we're going to take the premium, which is the total cost basis of $800. Now our insurance was $1,400, but that's for 2 days. And this won't decay nearly as fast as this. So we're going to get the difference between those two. And that's the goal, right? So, and then we'll have good insurance. So if the market does flush and come all the way down to here outside of our cone of probability at expiration, well, we'll have a lot better insurance policy this time. We won't lose nearly as much money. So let's calculate our cone of probability. So our cost basis is 820. So we're going to take 820. And you can do it a little bit more accurate. This is 480 and this is 340. So we could actually do it a little bit more accurately because we got to put skew in there. So take your dollar calculator and we just say from where we bought these things, or where we sold them actually. We sold the put for 340. So it's going to go this way, 340. That's all we got out of it. 340. That's about as close as I can get. 350. Let's go stretch it out a little. Maybe we make it a little more accurate. All we got was 340. That's not very good. Okay, so we got 340 on this side, and on this side we got an extra We got 480. So we go 480 on this side. 480. So that's our cone of probability right there. So we're going to draw that across there, draw this across here. Take our little cone drawing tool. We'll come in here, and that's our cone of probability from there to there to there. Now the market just has to be inside that cone for us to get our full profit. So that's kind of what we're looking at. It's getting crazy right now. 8:30. Did we have something come up? Was that our new home sales? Because the market's going nutso right now. Let's go look at our news events. 8:30. Oh, that was gasoline stocks. New home sales came in at 8. Did anything happen at 8 o'clock? 8:20. 8 o'clock was right here. And it kind of rallied a little bit. But now it's flushed. Now it's back to almost dead center again. Look at that. Our bot call and our bot puts right at 0. 137 exactly right on the numbers. And then our sold options, we got a little bit of a skew in there. See that put skew? We're losing 140 on the put, and the call. Oh, I got to move myself. You guys can't see it. There we go. So we're at 1250 up on the, but we got that put skew. That put skew is what, see the sell put? The sold put is 145 and our sold call is 125. The difference between those two and why they're not exactly the same, even though they're both as put and call at the exact same strike, that's called put skew. It's also going to be implied volatility to the downside because the market's flushing right now. But that's your put skew right there. What's put skew, Lan? That's because more people buy puts than calls. And the reason they do that is because they're using it as protection for insurance to the upside. So if they're long the market, they buy puts to protect themselves to the downside in case the market flushes. And they don't want to sell. They don't want to sell their long positions. See, a lot of people will say, well, the market's going to go up. So they'll come in, and it can't, we can't do it on this one. We've already got options on here. We can't really do it over on the other markets either because they don't have very good options. Maybe we can do it as an example. We're in the demo account. Let's go see. The Russell's not going to do it. Maybe the Dow. Let's go see if we got some. So we come in here. Let's do 2 days. Absolutely nothing on the Dow. Sorry, guys. That's not going to work. Let's go see if we can do this example on the NASDAQ. There's the NASDAQ. Oh, look, it's trying to rally. So have we got any options? No, nothing. Let's see if we can do it anyway. We're going to try it. Okay, so you come in and you buy your put option right at the money right there. So you buy your put option the same time you buy a long position. So we're going to go ahead and replace that. See if they'll give us one. They got it. Okay, it's a demo account. They let us have it. Now we take a long position. Okay, so we're long and we're short at the same time, right? So we got a long position on with our order, and we also have a short position on with our option. Now, the problem that we've got here is that the option has a delta of 0.50. So this is what we call a hedge. It's not a perfect hedge. It's a hedge. Now, it'll be a perfect hedge at expiration, which means that at expiration, if this market falls, we won't lose any money. We won't lose any money at all. Why? Because they'll assign us a short position at exactly the same place as our long position. So the only way we would make money on this is if the market rallied or lose. The only way you're not going to lose any money. Okay. As long as you let everything go play through all the way till expiration. At expiration, remember what's going to happen is they're going to assign you a short position on that option. So you're going to get a short position from wherever that's at. You're going to get a short position. So if the market dropped $870, well, you're going to lose $870 on your order, but you're going to also make $870 on your put option. All right, it's called a married put. So here I am in the way again. How do I get myself out of the way? So that's what we've done here. So if the market goes up, now you have to pay for the premium of the option with the value of the long shares. This is how you lose money. You're like, well, how do you lose money with this? You can't lose money, Land. Oh my gosh, you just solved all the world's problems. I'm just going to do this forever. I'm just going to, every time I go along the market, I'm going to buy a put, and I'll be rich, rich, rich beyond my wildest dreams. Well, the way you lose money on this one is if the market doesn't go, what did we pay for this put option? $2,325. Well, that means your break even is at $2,325. It's way up here. So in the next 2 days, market has to go $2,325. Has to go to there to break even. So that, now we can come out here. Let's come in here, and we're going to go in, and we're going to say 60-minute chart. Did it switch? No. 60. Oh, that's a range 20. 15-minute chart. See what we got there. Now, the problem is that we've got, it's too far off. There it is. Clear over there. Okay, let's shrink this chart down a little bit. See if we can get it all on the screen at once. There's your cone of probability. Okay, so here's your cone of probability. This is how this works. Let's clean this up a little bit. Do you believe that the market is going to go from here to here to here? All right, that's your cone of probability. And that's actually got to be red, not green. This is a red one. Oh, that's just the line. Light pretty red. Ooh, that's garish. Ooh, that's garish. Sorry, I don't have a light pretty red. There we go. That's better. All right. That is your cone of probability. Land, my goodness sakes, get out of the way. So if the market closes hits inside this purple line right there, you're going to lose money. And you're going to lose however much money it is in the market. Actually away from the market. So I'll go this direction. So wherever the market's at, it's how much money you're going to lose. So you come down here. If it comes in a dead center of that, it comes in and closes out right there, you'll lose $1,350. That's how that strategy works. But if it goes down, if the market falls, you don't lose anything. There's no loss down here. So that's pretty cool, right? And that's why you get a lot more people. That's why you get a lot more people buying puts, because they're buying long contracts and they're hedging them with a put option. Now, you can give yourself a little bit of you can actually put your put option down here one strike, and that would drop it'd be less expensive for the premium of the option, but then that would drop if I can grab it, that would drop you'd end up with something like that, right? So however much you would, if you didn't buy your put at the exact same strike price, you bought your put down here further away, you wouldn't pay as much for it. So this would actually probably come down a little bit too. Probably more like this. So you're going to recenter your cone of probability to a different level. So you can move that cone wherever you want it, depending on where you put your put option. So that's that married put. So you're long, and then you buy a put to protect it to the downside. So that's how that works. So tomorrow, the market has to just be above. It just has to move in the next 2 days. It just has to be up here somewhere. And then you can put your stop in at break even, right? So the whole idea is that then you'd put your stop in at break even right here. And then as long as the market runs, it runs. And then what happens? It goes up, and then it's like way up here, and then you're like, oh crap, it's starting to turn around, come down. Well, you buy another put option. And you don't have to wait for it to come all the way to the end. I mean, if the market really starts to rally and it's way up here, it's going to show a profit and you can take it off. But this is I call them soft stops. Actually, the way and the industry calls them, the real word, the guy who made it up in the first place back in New York in some office building, he calls them married puts. But I just call them soft stops because it's a soft stop. I mean, it's going to, it doesn't ever come off. It doesn't, if the market hits it, it doesn't come off. It's soft. It'll fluff through it back and forth. If it hits those numbers, it doesn't come off. It doesn't get you out of the market. I call it a soft stop. All right. I think my terminology is way better than the guys in New York. I like wild eye, crazy eye, iron butterfly way better than whatever the heck it is, which doesn't have a name. I like my names way better. My naming nomenclatures are way better. Let's just leave this on for now, just for fun. We'll see what it does. We'll look at it tomorrow and see where it's at. All right. Okay. We're down $27. That's no big deal. Look at that flush, though. It flushed way away, didn't it? Way away. Came back up. Now it's flushed way back down. Let's just see our chart. Where are we at? We're only down $37 after that big move because we've got good insurance. So it's not scaring us at all. We're only down 7. Look how that market flushed right out of just immediately. As soon as we got into it, it flushed all the way down. And if we'd had crappy insurance, we'd be down a couple $100 right now. But because we have really good insurance, we're only down $30. That shouldn't scare anybody. Oh, I'm in the way again. Can't see the accounting. There's your accounting. Look at that. We're only down $25. $30. And that market just flushed right away from our orders. I think this is the best strategy, guys. I kind of landed on this one. I don't want to do the others unless we're just really confident the market's just going to be dead and go sideways. But how confident are you the market's going to ever do that? The thing is that if you look at our spreadsheet, this will be the last thing, and then I'll let you go. Class will be over. But if you look at our spreadsheet and we go to May, and we started putting these things on in May. But if you go back and look, that market was just dead in May. We didn't have much of a trending market. The ticks were really small. Mostly we just had really good winning days. We just kind of threw them on there and tested a bunch of stuff, and away they went. But this month of June, look at how many losers we've had. That's because the market's been a lot more aggressive, a lot more action, a lot more markets moved out of our cone of probability. So, that's the crapshoot you're playing. Do you want to buy good insurance, pay more money for it? Or do you want to have less insurance, pay less money for it, and maybe make that extra $100? It's up to you. I think I'm leaning towards just pay the extra higher premium and be covered better. 66% of the time the market leaves. So it leaves our cone. So we know that, statistically speaking. So I guess we might as well just buy really good insurance. Rotten drivers on the road all the time. Just always consider that we're in danger of being run off the road wherever we go. All right, guys, I got a Sunday school lesson for you. We'll end with a Sunday school lesson, and then we'll let you go, and we'll come back, and we'll see how these things turn out tomorrow. All right. I oftentimes say don't reverse trade, but then I go and reverse trade because I like to reverse trade. But in the beginning, don't reverse trade. If you get stopped out, that's not a reason to reverse your position and go the other direction. Actually, it is. I mean, we've said this a number of times. A failed pattern is oftentimes the best pattern in the opposite direction. But in the beginning, I don't want you guys reversing. I want you to just, if you're wrong, get out. All right. Wait for a clean new setup trigger before you try enter again. And then that keeps you from over trading. So until you get a lot more experience and you built your account up and you have a real nice big green buffer, don't reverse trade because it's a quick way of giving up all your money to somebody else. But granted, it's also a great way of catching a failed pattern that moves in the opposite direction. So keep that in mind in the beginning. As new traders, don't reverse trade. But as you get more skill and more experience and you have a bigger buffer, a bigger green buffer, and you got some money you can play with a little bit, you're playing with the house's money, then go ahead and try some of these reverse trades. But make sure you do them in the demo account first so you get your skills down, and then you can start reverse trading once you get some skill. But in the beginning, please, as beginners, don't reverse trade. All right? Don't just get going back and forth, in and out, in and out, in and out. All right, let's go say hi to a few people that I haven't said hi to. Let's go down through and see who gets the gold medal today. That's Kirk. Kirk gets the gold medal. First thing pops up in the morning. And then we got Gary Thomas coming in with silver. And we got Kim Moss coming in with bronze. Nice to see you guys coming in first thing in the morning. Then we got Bruce coming in with fourth place. And we got Michael Bruce coming in. Kirk Schwartz saying hi. Mark Boucher. Great to see you, Mark. Have I been using the drift pattern lately? No. Can't remember what it is. What's the drift pattern? I remember talking about it. I can't remember right now. It's off the top of my head. And then we got, Kirk saying chop, chop, chop. All right. I think we've addressed the rest of them. Everybody coming down through here. Anybody have a last comment before we let you go? Let's see. Michael Bruce says, truthfully speaking, I came to the conclusion as well, even though I like the chicken wing. This strategy beats it in terms of raw profit and minus losses. I think so too, Michael Bruce. I think so too. But remember, the chicken wing is just a one leg of a iron condor, but we can do one leg of an iron butterfly. So if you have confidence in this market and you think that maybe, there's no reason to, the market's flushing, we can do a chicken wing of this exact strategy. We just only put on one half of it. Why take the other half if you're pretty confident the market's going to have a big down day or a big up day? Just take half of it and not worry about the other half because you're going to give it up anyway. You might as well just trade half of it. So we can do the same thing, Michael Bruce, just do it at the money as opposed to at a delta 20. All right, guys, I'm going to let you go. Have a great evening. Tomorrow I will be back and we will do, I think I'm going to be able to do, I think tomorrow we do, we do power hour. Look, we're back dead center again. So it's flip-flopping right back and forth, come right back to the VWAP. That's why I like putting these things on right at the VWAP. All right, so tomorrow, Scalp and Trail for Power Hour. Scalp and Trail Power Hour. So we'll see you guys tomorrow afternoon for Power Hour. And Kim Moss, I think I have an appointment with you today. So I will be giving you a call in a little while. And we'll set up your software and help you get things rolling. All right, guys. We will see you tomorrow.